There are some things I'll take a chance on, but life is already enough of a gamble for me to put my whole nest egg in the share market. So I take a calmer path. By investing in private credit, I know my money could be growing, not yo-yoing.
From Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, I'm Andrew Gagan. Welcome to the COB on this Friday as we round out the day and the week here at AusBiz. Let's take a look at the market then. And we are slightly negative for the day, just bumping on at that level in the past couple of hours, but it looks as though we're going to finish off around 0.1% on the CBO 200. Just dipping there, risk-off sentiment triggered by the Gaza peace plan, which sent oil and gold stocks down in particular. In fact, the materials sector was the hardest hit there. The iron ore miners also hit, given a price dispute with BHP and China. In fact, let's get to the themes of the day then. Art of the deal. Well, we know who that's about because he trumpets. That's what he does, is Donald Trump certainly taking credit for that brokered peace deal between Israel and Hamas. Yet to be seen whether that actually plays out, of course, with the hostages due to be released, I think on Monday is the plan. But that did obviously affect commodities. So concern there, just in regards to those prices coming off, obviously with that risk premium coming out of what we're seeing in the Middle East there, with both oil and gold dipping. And it has turned out to be a weak week because we're down around 1/3% on the week. In fact, most of those falls occurred at the beginning of the week on Monday. Let's get to the sectors, see how that played out. And I mentioned the miners. That's certainly where the pain has been felt in today's trade. Getting to those sectors, if we had them up, do we have those sectors? It would appear, yes, we do. There we go. So BHP, as I mentioned there, there's this price dispute over iron ore between the mining giant and China. It looks as though that could drag out to the end of the year at this point. Rio Tinto and Fortescue coming off similarly there. Now, I mentioned the gold miners. The gold price, having recently, of course, hit that record above $4,000 US, it did take a tumble overnight, down more than 2%, and that was an excuse for some hefty profit taking going on, particularly among the bigger miners and producers there, with, Ramelius and Genesis, perhaps the hardest hit there. Genesis down almost 6%. And also in energy, with the oil price moving lower off the back of those developments in the Middle East. So Korean energy, the hardest hit there, off around 3%. The bright spot being tech. Perhaps reflecting what we saw on Wall Street too, although WiseTech was marginally lower. But Tech One, also Life 360 among the best there, that is higher too today. Just getting to the top stories, Goodman and Gomez slipping, with Morningstar unimpressed with the share buyback plan. Qantas gaining altitude despite being one of 39 companies that may be unable to stop a data breach involving millions of customers on the dark web. Mineral Resources appointing 2 new non-executive directors to its board. Chris Maher has stepped down from Digico, where the board that is, where he sat as a non-independent director. And GQG Partners recording a slight decline in funds under management in September. Well, let's now turn to our stock of the day. It was Findi, which obviously has that key presence in India. To get across what they think of the stock, we heard from Ben Richards from Seneca Financial Solutions and Luke Winchester from Merewether Capital.
You know, it's hard to, there have been some pretty inflammatory comments made, and it's hard to comment too much on that, but we've always had kind of reservations about the business model, the balance sheet, and the management. So I'll leave the viewers to go and do their own research and have a look into all that. But even if any of it's true, it's kind of a bit of a knock on the business. And yeah, it's just, again, it's not where we're kind of investing clients' hard-earned money here, I suppose.
the business that's listed on the ASX owns a percentage of the Indian operating business, and there's debt and convertible note instruments in both of those vehicles, and some of them convert based on an IPO in India. It gets very complicated very quickly, and to me, my main fallback is it's the sort of capital structure I wouldn't expect to see from a business that says that it's profitable and generating cash. So that's what's kept me away. I said sell back then, I would say sell now. Even despite the opportunity, I get the India story, I get the IPO, the potential's there, but there's just too much risk. And for your average investor, it's not worth taking on. So I'll stay with the sell as well.
And that was a double sell for Findy, our stock of the day, which is actually off about 40% this year thus far. Let's now get across the week that was, and to do that, we are joined by Shane Oliver for AMP. Shane, welcome back. Good to catch up with you again. Let's first take a look at what we're seeing globally at the moment, particularly in share markets. And well, interestingly, that Australia continues to lag, but we did see some gains across, particularly Wall Street there, hitting new records. And ongoing concerns about those valuations, in particular talk of a bubble, particularly relating to those AI-related tech stocks.
Yeah, we have seen more of that talk, and I think it's understandable given the gains we've seen on Wall Street, and particularly in the tech stocks. And over the last few years, the Magnificent Seven, so to speak, have been accounting for 50% or more of the gains on Wall Street in the S&P 500. So comparisons are being made to what we saw in 1999, 2000, and obviously that's raising some concerns. And so every day you get a softer market in the US, then that story is sort of wheeled out. You know, investor concerns about a rerun of what happened in the year 2000 with the tech boom bursting. You can see on the chart there just how strong markets have been, mainly in the US. And of course, this is heavily affected by the start date. But we did see that big dip into April on the back of Trump's tariffs, and then markets have recovered all of those losses and some up. I think the US market's up about 35% from its lows back then. And that, of course, has taken PEs to relatively high levels in the US, around 23, 24 times on a forward earnings basis, which is only just below the 26 times we saw back in at the tech boom peak. I guess there are some big differences, though, and one of the big ones is that these tech companies are making big profits and they're seeing big profit growth, very different to the dot-com stocks of a generation ago. And also there's so much talk about a bubble, you sort of wonder whether it's actually it is a bubble. If everyone's talking about a bubble, then maybe it's not. And so that's a bit of an issue as well. And sentiment, when you look at it, is not quite as ebullient or as euphoric as you might see at a major market top. So a lot of uncertainty around this. My feeling is, yes, share markets are due for a correction, but I've probably told you that several times over the last few months. And of course, the market just keeps going higher. But I sort of struggle to say we're about to hit a major peak. That said, I know historically that midterm election years are known to be quite volatile. I think the average correction in midterm election year is 17-18% if you go back over the last 50 years or so in the US. So we could see more volatility coming into next year. There's no doubt about all of that. But as long as the US economy is still growing, you're still seeing interest rate cuts from the Fed, and it looks like, given recent Fed officials' comments, including New York President Williams overnight, that those rate cuts are still ahead. So all of those things I think are positive, but yes, there is that uncertainty around whether a bubble is forming. The only thing I would caution, though, it's very hard to predict the timing of these things. Back in the mid-1990s, there was a talk of irrational exuberance in the US. And of course, a lot of people have read that book just behind me there, Mania's Panics and Crashes, and are sort of aware of these things. But trying to time when these things peak is very difficult. That talk in the mid-1990s was 4 or 5 years ahead of its time. Yep. The actual falls did not occur until 2000. So you can run the danger of getting out too early, missing out on gains, and then get whipsawed again if you get back in at the top. So that's also a risk, trying to time these sort of things.
Yeah, that is a well-placed prop you have right there. I was just about to ask you about that, Shane. Now, speaking of bubbles, precious metals, are we seeing that there? The price gains in gold have been quite phenomenal. What are your observations, and particularly historically, how this is well-placed?
Well, I find this one quite interesting. If you look at it historically, some people might say, well, gold has become a bubble. And, those images of people lined up outside ABC Bullion, I was told yesterday, the queue went for 60 metres or so to pick up their gold might be a sign that it's become a bit of a bubble, once when everyone's getting into it. And it's become a retail phenomenon, then maybe it's not like that old saying, once the taxi driver tells you to buy shares of gold, and then you start to get concerned about it, maybe it's at the top. The only thing is that when you look at its upswing in the great scheme of things, it's pretty mild compared to the run-ups that we saw in NASDAQ in the year 2000, the Japanese share market, even iron ore into last decade. It looks like a bit of a non-event in the great scheme of things. NASDAQ's been going up faster than gold in recent times, not necessarily the last couple of months, but over the last few years. And there are some fundamental factors behind the run-up in gold. It, I think, partly reflects concern that there's a lot of public debt out there. Some investors are trying to seek a hedge against that in the form of a hard currency, so to speak, on concern that governments will try and monetize that debt or inflate it away with higher inflation rates, the geopolitical worries. We're seeing central banks cutting interest rates, which reduces the disincentive to hold gold. We're seeing a downtrend in the US dollar, and of course gold is priced in US dollars. So there are some fundamentals factors behind it. I think it is very overbought. It is due a pullback, but it may be too early to say that it's at the top. And I think the factors that are driving gold are similar to Bitcoin in the great scheme of things, but there's no denying there's a speculative element to it in there. And that obviously means investors need to be cautious. And if you look at the history of gold, I mean, often people look at the last 2 years or the last 2 months and say it's a sure thing. It's doubled over the last 2 years. It's gone up 50% so far this year. Must be a sure thing. Go back through the history of gold. It did have a 20-year bear market from its high in 1979 to its low around I think the high was in 1980 actually, at around $850, and the low point was 70% below that 20 years later in 1999. And then, of course, we had that great run up into 2011, almost gets to 2000, and then almost halves in value over the next 4 years. So you can go through lengthy periods in gold where it doesn't do so well. So you've got to go in with your eyes open if you are thinking about taking a big position in gold.
Yeah, certainly the technical analysts have been warning of how far and it has moved beyond way what they expected. Shane, just very briefly, we did hear from Michelle Bullock this morning appearing before the Senate. Also comes as consumer confidence came off this week. Anything particular you heard from the Reserve Bank Governor?
Oh, geez. I listened through that whole thing and I thought, oh my God, this is putting me to sleep. Some of the questions were a bit more intelligent than you normally get out of the senators. So that was quite impressive. But I don't think she said anything new. She basically said that, I think, my summary of it in terms of interest rates is that the Reserve Bank is still cautious. It has to allow that maybe they don't need to cut rates as much, given the upswing in the economy they're starting to see. But by the same token, I don't think she was asked precisely, but if she was asked, do they think they're going to cut interest rates again, I think she would have repeated, I don't know. And that chart there, she referred to the softness in consumer confidence, which is still down at reasonably low levels. It's had a nice run up, but as we've seen in the last couple of months, after those higher inflation numbers in July and August, and the more hawkish comments from the RBA at the last meeting, there has been a bit of a pullback in confidence, and it's still below what you'd regard as normal levels. So, I to be honest with you, I didn't read too much into what she said or get anything new out of it. From what we heard a week ago. So I haven't really changed my view, which is I think we'll still see 2 more cuts. But I acknowledge there is a lot of uncertainty around that, and it may be the case that we're already close to the bottom on rates.
Now, Shane, I know something that doesn't put you to sleep is music. Well, maybe it does, but that's chosen depending on what you're listening to. But you are a well-known music buff. We've actually got a question from a viewer. His name is Stephen. He said, I'm about Shane's age, but never bothered to listen to Taylor Swift. As an expert on economics, pop music and literature, that's you, Shane, what would be the best Taylor Swift album for a newbie to start with? What do you think?
That's an interesting question, and I like that the viewer. I didn't get into Taylor Swift until a decade ago, And I would probably recommend, I mean, it depends on the person's taste. If you want something which is really slow and introspective and might put you to sleep, as it did with me, you'd listen to Folklore or the album that followed that. Although I have been too negative on Folklore. There's a song called August, which is a really, really good Taylor Swift song, which for some reason I forgot was on Folklore, so it does lift it a little bit. But if you're wanting something more upbeat and classic poppy, catchy songs, then I'd go with 1989, which out of interest was the album I got into with Taylor Swift. I mean, she'd been around for a decade or so before I discovered her. 1989 has some really classic Taylor songs, style, obviously, Shake It Off. And the more I listened to it over the years, I reckon it's a fantastically good pop album on the boppy side. The problem with the more recent albums, I think, was that 4 of them, up until the most recent one, were just a bit too slow. And if you listen to the Tortured Poets album, and there was 31 songs, I think, altogether, you'd think this is a bit too tortured.
Well, of course, Shane, it does come on the release this week of the latest one, being The Life of a Showgirl. So have you had a chance to listen in its entirety?
I have.
Yeah.
I have. Nadine asked, out of interest, Nadine asked me about that last week, and it had only been out for a couple of hours, and of course I was working on the day and had only had time to listen to the first 4 songs. And I think I gave it a rating, at least on the basis of those first 4, of 7 or 8 from memory. And I'd affirm that I'd probably go towards 8 out of 10. 1989 is probably a 10 in terms of ranking, of rating Taylor songs. I think it's far better than the previous 4 that started with Folklore, which were all a bit too slow for me, generally speaking. This album is not as boppy, say, as 1989, but it has a lot of really catchy songs on it. Fate of Ophelia, Opalite, Father Time, I think it's called, the title song, Cancelled. There's a whole lot of good catchy songs on there, and the more I listen to it, the more I like it. So I'm actually quite impressed with this album, and I would rate it 8 out of 10, even though I'd say style is a 10, and one of my favourites is another 10, which is Lover, which was the album she released in 2019 and had songs like Me on it and You Need to Calm Down. I thought that was just fantastically good. But in any case, I think if you're just getting into Taylor Swift, 1989 is probably a good place to start. Obviously, why is it called 1989? Because she was born in 1989.
Well, Shane, you are a music encyclopedia, it has to be said. We'll see whether there's a new Swiftie that's joined the ranks in Stephen on your recommendation. Hey,
that's right.
Shane, have a terrific weekend. Thanks for joining some AMP.
Thanks, Andrew. Take care.
All right, cheers. Okay, let's wrap this up. Let's take a look at the best and worst in today's trade then, beginning with the best being Netwealth, off the back of an update there on its current position, up 6% there. Temple Webster, the online retailer, also doing well. On the negative side, should be no surprise that the goldies are leading there, given the sharp sell-off we've seen in the wake of the gold price coming off. Let's check in on what's happening overnight. Now, this may well not pan out because of the ongoing US shutdown and the release of data, but due to get Consumer Sentiment Index and also the federal budget balance for September. Now, in the week ahead, we do get international trade data out of China. Of course, that's an ongoing concern given the tariffs. The RBA meeting minutes from Tuesday. Fed Chair Jerome Powell due to speak also on Tuesday, and once again US CPI, that may not be forthcoming also, and locally we get labour force data as well, as Michelle Bullock will be speaking later in the week. So just recapping where we're finishing on this Friday, off almost 0.1% to be down around 0.3% for the week. That is the COB. Thanks for watching and listening.
Brought to you by Montgomery Investment Management. The world is volatile. Your financial future doesn't have to be. Find out more at montinvest.com.